everyone. Thank you so much for finding the time to attend the webinar today. I'm Shrishti Sriram, and I'm the head of marketing and partnerships at YNOS Venture Engine, which is a technology platform for business intelligence and fundraising analytics for early stage startups and entrepreneurs. The webinar today is a part of the webinar series of our Clarity product, and this is the 5th webinar of ours. So do keep an eye out for our upcoming webinars. Before we begin, a quick note that throughout the presentation, I will be managing the chat functionality. You can enter your questions and comments in the chat panel throughout the presentation. We will address all the questions at the end of the webinar. So let's start. Yeah.
Thank you. Thank you. So everyone, my name is Kaushal Agarwal. I'm one of the 3 founders of a firm called Avendus Capital. We are a 20-year-old financial services firm now. We have had a very interesting journey because we started in a very interesting era when India was seeing its first surge of startups. A lot of you might be very young, but our first surge of startups actually happened in 99, 2000. And we all were 25, 26-year-old, and we started the company at that point in time as a .com company. We have evolved actually multiple times over the last 20 years, and we finally became a financial services powerhouse, a diversified financial services firm. We are into 4 businesses. Our largest and oldest business continues to be investment banking. We are the multiple parameters, the #1 investment banking firm in the country. We continue to work a lot with startups. And some of the leading startups in India, we've actually raised billions of dollars for them. And these are common household names like Big Basket, Swiggy, Paytm, etc. We also have the largest hedge fund business in the country. We have managed close to $1 billion in that business. And we have one of the largest, 4th largest wealth management business in the country, as well as a lending business, which is still evolving. So it's a fairly diversified firm with about 400 people, not a retail firm focused on specialized segments, and very differentiated in whatever we do in those segments. And we had a very interesting journey. So the idea of this presentation is to share some of the journey, memos of the journey that we have done. And to make it interesting, what I thought might be good is to actually use some movie characters, some comic book characters, because it gives a part of our story far more clearly. One of the biggest things which, when we started the business, was the fact that in financial services, a lot of companies are very old. They are about 50 years, 100 years, 200 years. And if you look at the origin of whether it's JP Morgan, Citibank, HSBC, a lot of global banks, they go way back. And when we became Avendus, a lot of investors used to ask us this question, that how will you guys compete and beat the global institutions which are operating in this market? And frankly, we didn't have any answers. But one conviction we had, and we continue to have, is my first slide, which is small is big. Essentially, as a smaller player, you have distinct and unique advantages, which typically larger players don't have. One is the sheer number of degrees of freedom that you have. You can choose your own path and your own destiny without actually really having the constraints and boundary lines of a large company. You can place your own ecosystem in place according to your wish. You can pretty much hire at will the kind of talent that you want without the constraints of human resource of the previous organization. You can create innovative organization structures, which won't be possible, which in a big company. So small is big is one of the biggest hypotheses that we have worked on. And over the last 20 years, we have seen that work multiple times. Just to give you a sense, when we started out and we pivoted from our initial model and became an investment banking firm, we found a niche, which is cross-border mergers and acquisition between India and US on the IT technology side. And we ended up doing close to about 120, 130 acquisitions between Indian IT companies and US IT companies. in a period of about 7 to 8 years, culminating with us being appointed by the government of India to resolve the crisis which had brewed in Satyam computers. And we actually helped government of India solve that crisis by selling Satyam computers to Tech Mahindra. And that 9 year journey essentially was completely focused on largely doing taking companies in US and selling them to Indian IT companies. Uh, and that kind of degree of freedom we wouldn't have had if we were a large company with cross-border teams in place, because we could actually fly in, fly out between different countries and actually enable these M&A. We could actually conclude those transactions. So small is big. We are seeing in multiple cases. Even when we started a hedge fund business, we started as a very small business, very tiny business in a niche, but a growing niche. And over a very short period of time, 3 years, it has become the largest hedge fund business in the country. Another aspect related to this is what is small today is likely to become big tomorrow. So a lot of big companies, they end up ignoring the real tiny, the ant-man of business, because they don't realize the kind of niches that business can go into. Uh, the second part, which is a big part of Avengers story, is diverse team with one strong gelling force. You see all the Avengers out here with one Captain America. And if anybody's seen Avengers movies, it's amazing how there is conflict between different people in the team. And they all have very diverse skill sets, but they still continue to fight as one force normally, right? And same thing happens in organization companies. We were lucky actually at some level to have a fairly diverse team. And I'll come to the one gelling force as well. So the diverse team between three of us, which is the founders and the initial set of people who joined us, had very different skill sets. One of us was very good at execution, one was fantastic at relationships, and one of us is extremely good at strategizing and thinking through the future. So there are multiple skill sets which actually come into picture simultaneously, and you have to choose that team very carefully, because if you don't have those diverse team with complementary skill sets, you might actually tread on each other's toes a bit too much, and that's something which you don't want initially as a startup. And the gelling force, sometimes can be a human, but a lot of time it's the value system. So the gelling force between the three founders of Avendus and the initial team was largely the value ecosystem. And the value ecosystem was pretty much ingrained in some of the middle class upbringing, the way we treated money, the lack of specific desire for a lot of personal capital, but lot of desire for building a great long-term organization. And these things actually pull together fairly well into one consistent force. And over long period of time, that value system, that strong gelling force, has actually kept the team together. And we have kept on increasing the diversity of the team over last 20 years, and kept on adding people who actually could increase the value of the firm and help us navigate uh, the various crises much better. One of the things which we didn't do well initially was hiring a lot of good senior people. And if I have to go back and change something, I would actually go back and hire far more, some high quality senior people early on as well, because they bring a level of maturity to the team, which sometimes can go missing. The third thing, which actually, this Thanos is trying to kill somebody out here. I don't recognize who, but the is survive. I just don't die. It's like it's especially true for financial services. Over last 20 years, we have seen almost 60 to 70% of brands which were there 20 years back dead, and you know very few have survived. And you will see over last 2 years, also a lot of financial services brands have died. but it's true for pretty much every industry. Every evolving industry has has very few survival rate. The survival rate in entrepreneurship is extremely low. And if you're building a company, it's so easy to die. Uh, Typically, you die from multiple reasons, but the biggest reason to die is lack of money. So you need to find a way to be liquid. And I'll just take you through some incidents in our lives which we survived through. So the one of the biggest incidents was a 2008 financial crisis, the Lehman crisis, and that crisis really we were actually negotiating a term sheet and an agreement with an investor in US, and just a couple of weeks before the crisis, actually with two investors, one in US and one in Middle East, and just a couple of weeks before the crisis, the US investor frankly told us that, we don't think it's the right time to actually do a transaction. So, they actually reneged on the transaction. The other investor in Middle East continued to be keen, but was becoming slightly circumspect. Pretty much the similar scenario which is today. 2008 financial crisis. There was another crisis at that point of time. Different in terms of the nature of the crisis, but it's still a financial crisis. And what we did is we essentially our board was actually dithering. Our board was not clear whether we should take that money because some of the terms were very stringent. But we as founders understood that crisis is actually going to stay, and we needed capital to actually grow. So we bulldozed our board and our found other set of investors to actually take up the Middle East offer and actually close the transaction. And that money was extremely valuable because it helped us build few businesses which wouldn't have been able to build otherwise. So survival is extremely critical. And today's market is actually a great example of a market where people need to survive. Uh, and one of the things which a lot of is underestimated is the sheer will and doggedness required to survive in markets like this. Uh, so we had a similar incident in 2000 when Nasdaq crashed and we had to survive. What we did was, fortunately, we had a good bunch of investors. We asked them for our last line. We just told them that give us the last line of financing which you have, and we will somehow survive on the basis of that. So they gave us 25 lakh as survival capital. Sounds like a small number now, but it looked like a big number those days. And we actually survived on basis of that 25 lakh and build the business back, from complete scratch on the basis of survival line. Um, this one's my favorite slide. The reason I put pivot and be opportunistic completely inverted is because pivoting needs sometimes completely out of the box thinking. And one of the biggest things which people, entrepreneurs sometimes miss upon is get married to their own initial concept and initial hypothesis. So most entrepreneurs are extremely passionate about what they start out with, but sometimes they get married to what they initially started out with. With changing circumstancing and changing markets, uh, you need to change. You can act, and if you change well enough, fast enough, sharp enough, you can be pretty much like the Superman on this image, which is, you enter in a very different format and you actually can come out as a Superman. And one of the biggest examples of pivots, of course, has been Amazon. When they, during the downturn of 2000, 2004, consolidated a lot of assets and built their whole Amazon Web Services business, which gave them enough profits to survive and build out the Amazon consumer business over next decade. As far as we are concerned, we have pivoted multiple times, and every pivot has been very painful and extremely and required complete reorienting, retooling the business from multiple perspectives. The first pivot we had, we actually started as a company called coolstartups.com. And that was during the Nasdaq peak days, and it was mirror of a company called Garage, online digital platform for startups. Within 9 months, we had to actually figure out what do we do, because there was no revenue model, business model on startups left. And that's where we opportunistically figured out that there's an opportunity of doing tech M&A, investment banking between India and US, and converted ourselves into an investment bank and became a cross-border M&A firm. So that was the first pivot that we did. Extremely opportunistic. If you ask me, was there any research background to it? It's just intuitive sense of where the money is going to be made. So very much follow the money and follow the opportunity kind of phenomena. The second pivot we did is more diversified financial services, which is we entered into beyond investment banking, other businesses, which are wealth management, asset management, and lending. This was far more deliberate pivot, and this actually had a lot of research. There's a lot of market data, market research, a lot of reading which went into that. So this was almost a 2-year effort which went into doing this pivot. So depending upon, it's a strategic pivots can be various types. Strategic, thoughtful pivots like the one which we did, the second one, or the first one, which is more intuitive, is I would call the survival pivot. In today's crisis, right now, for example, I think a lot of organizations, companies will have to do survival pivots, because a lot of initial hypotheses, business models are going to go for a toss. And we will see a lot of interesting creative entrepreneurship coming across. People are actually, you will see some entrepreneurs just coming out completely out of the blue and becoming big because they're showing resilience and ability to turn, change, and become extremely opportunistic towards the new reality and the new world. This is an interesting one. Going long on talent, it also is one of the toughest ones to do, because you have to sometimes, to build an organization which has very similar culture, very similar set of people. You need to invest behind young talent and groom that talent over a period of time. We found that people who have been with us over 10 years, 15 years, 20 years, and catching that raw talent absolutely young can create enormous value over a long period of time. So one is, of course, you need a commitment to build a long-term business. Otherwise, building this talent pool can, it takes time. You need to actually, it's like seeding a small seed and, growing it step by step. But if you do it right, and the great organizations in the world which have, gone on to become institutional frameworks, whether it's the Goldman Sachs, whether it's Amazon, all these organizations actually invested a lot behind talent early on in their evolution of the organization. So we actually started investing behind talent from 2003-4 onwards, and started hiring from IIMs and IITs very early on. Even now, we are one of the top recruiters from, and we worked very hard towards that actually to get the right kind of response from campuses, because all students have choices, and so we had to actually work hard on our campus brand, work hard on training. We are creating our own university right now, which is a digital university to train the talent, because we find that in financial services in India, training is something which is, the talent is not really given to the level that is required. We are creating our own curriculums. So going and long on talent, breeding that talent step by step is extremely critical. And if you want to build an institution and a long-term institutional framework. Deadpool, very good at killing the bad people, but not really, has a great reputation, right? So in our case, we have seen that reputation, how you do matters as much as what you do. It's very easy sometimes to take shortcuts to actually achieve certain outcomes. And our experience has been that shortcuts typically end up boomeranging back onto you. And in certain businesses which are driven by reputation, and I can name a few of them. It's not true for every business, but education, healthcare, financial services, there are few businesses where reputation matters a lot, where people are putting at some level very something which is very core to them in your hands, right? Whether it's money, whether it's health, whether it's education. And reputation is very easy to let go of, very difficult to earn. So it's a constant exercise. It's a continuous every single day exercise to maintain and grow your reputation. And it takes decades to build a reputation. It sometimes takes very, very little time for the reputation to actually go away. um, just to give you an example of, we had actually uh, about 12, 13 years back, 14 years back, got a mandate from a company to acquire a company in US, and we thought we haven't done a good job. And we actually went back to them, and they had given us some retainer. We actually gave that money back to them, and they got pretty surprised. They said, nobody's actually, no service provider has returned money back to us. And that actually client ended up becoming our largest client, and they've made more than 17 $18 million of income for us over last 10 years. And pretty much I think they have been responsible for getting a lot of referral clients to us as well. So reputation is extremely important. How you deal with your people, how do you deal with your customers, how do you are you consistent in your behavior? That's something sometimes I think some of the younger startups in India are failing at. And they're earning, they're growing, they are getting a lot of funding, but I think they're doing a pretty mediocre job of protecting their reputation. And that's something which can actually go bad fairly, go down fairly quickly. And that's an option which is not there if you want to grow a long-term institution. um, this is something which, you can see the friendly neighborhood Spider-Man. Uh, it's it's easier said than done, especially if you're an entrepreneur. You're so busy building your business. You have your clients. You've got your ecosystem, which is trying to essentially, you're trying to make money. You have investors. How do you find time to network and make friends? But I would strongly encourage, if in any business, in any enterprise, whatever segment and sector, a bit of networking is required. And I think, especially in a country like India, which is a volatile country, which has too many participants. You have state governments, you have central governments, you have tax, um, you have so many people who are participants who keep coming and disrupting your business at some point or the other. It's always useful to actually have more friends and more people that like you and want to work with.
So the speaker seems to be facing some technical issues. So let's just give him a minute, please.
Sorry, I got logged out. Part of being in home Wi-Fi networks. Um, so networking and making friends is extremely important. And it's typically in your own ecosystem, in your own little ways, in your own societies. It's amazing how many random people have helped us over the last 20 years. People who knew us casually but came forward and helped us. Our first client actually came through a random reference of somebody I just met in Bangalore as a recruitment consultant for a couple of hours. And there are like thousands of such examples over the last 20 years where people have actually come forward. And what surprises me how helpful on an average people are and how much they want other people to succeed. I've got an innate faith in optimism and positivity of people around, and that helps a lot in building a business. And the last is something which is least spoken about. It's a happy Mickey Mouse, but building a business and a startup is, even if you have co-founders, you have investors, is a fairly lonely journey. And what ends up happening is, and of course, Deepika has made this famous with her famous uh, mental health, being open about mental health on the Bollywood side. But on corporate side, it's the same issues which, having worked with thousands of entrepreneurs over last 20 years, uh, personal challenges, health challenges, the fact that the kind of stress they go through, I think it's very difficult for a lot of entrepreneurs to navigate through that. It ends up, uh, vitiating their relationships, whether it's personal or professional. And it's very important to take care of both your mind and health, and of family around you as well, because it's extremely difficult to be an entrepreneur. And if you don't take care of that, and it requires a certain degree of discipline to do that. And it's very easy to go off that discipline given the travel schedules, given the work schedules, etc. But somewhere, somehow, it's important to take care of your mind. And some of the best people that we have had, we shared such a deep relationship with our people that we took care of each other's mind as well, right? So I think, if somehow you can form that bonding in a team, that's incredible. If not, I think you need to find your own individual journey to reach there. I think that's pretty much it in terms of your key aspects, learnings, whatever I could think through, figure out on what has helped us shape the company and Avendus over last 20 years. There are a lot of things which can be spoken, or we can make it up another 50 points. But these are the core 8 to 10 things which are important, and which have been important to us in building Avendus till now. I'm just going to get Hilai to maybe consolidate the questions. Just a second.
You can also stop your screen share as well.
Yeah, I'm just going to stop the screen share.
Okay.
Okay, I'm going to actually, on the question side, it'll be great to actually take me through the questions which are there, and I'm happy to actually answer any questions.
So I have a question from Naveen.
Okay.
So he says, so he asks, what would be the mindset of investors for the new startup pitch with the nominal investment values? So would it be hard luck for new startup pitches as well?
In this environment?
Mm-hmm.
So I think right now it's one of the toughest time to raise capital for any startup now, and it's going to be like that for some period of time. When such a big crisis happens, people just take risk off. They are very scared of taking any further risk. Most of the investors start focusing on their existing portfolio companies as well. And if they had, let's say, $1 billion fund and they put $900 million in existing portfolio companies, instead of putting that $100 million in new portfolio companies, they would rather keep it for existing portfolio companies. So yes, it's very difficult time for people to raise capital for startups. Second is there is so much ambiguity right now about how the future business models, especially in consumer, are going to evolve and come through. And people will want to wait and see how the world shapes up before they commit more capital. So it'll be a difficult time for startups to raise capital. Um, but some of the most resilient founders still will end up raising capital. I think it's about knocking more doors. Having a business plan which is fairly, the bar and the quality for the investors goes up also in this environment. So they will still invest, but they will be very particular, very specific. Um, the bar of quality of thought which the founder has to go up, uh, and the bar on the depth of the business plan will also go up.
Okay, thank you. We have another question. Survival pivot. How do you convince the team and your investors to move to a new business model?
That's a very relevant and very good question. Um, very, investors actually, the team, I think, our experience has been a relatively easy one, because the team, especially in the early stages of the company, is the team is fairly close knit, and they're aligned together in for the survival of the company. And unless they are becoming redundant, most of the top 5 6 people initially, they're on the same boat. A lot of the pivot comes out of the brainstorming of that team. um, and the rest of the team, I think, pretty much you can, either somebody aligns with you or somebody doesn't align with you. Somebody doesn't align with you, you can let go of those people. The rest of the people have to align with you. The key question is around investors. So if the investors had committed to a plan and you had to change that plan, sometimes it becomes an issue. uh, and because the investors have sold a very different business to their investors, which are the LPs, or their investment committee, and so they have to go back to their investment committee and tell them that, look, this business is planning to change. So there are investors who become very smart at this, and they are very open towards businesses and plans changing. But there are investors which can be very rigid, right? So I think the more storied, the more experienced an investor, sometimes they are better at pivoting because they have seen so many pivots globally. Some new investors who have not really gone through so many cycles might actually find it tough to adjust to and absorb to that level of ambiguity on a new pivot. Till I hope that answers the question. I got another question, I think, from Rajendran, which is, many tenets of finance have got demolished given the way governments are opening up the taps for funds. In this scenario, would conventional investing have a logic, at least for next 2 years? Um, I think investing fundamentally doesn't change. If you go 150 years back or now, the whole world has changed. And if you look at one of the few first VC investments which was done by JP Morgan behind Edison, that was in 1880s or 1890s. And so venture investing behind risk, marrying a entrepreneur with a risk taker investor has been in play for 130, 140 years. Even more, actually, if you go to East India Company, which is, in 1600s. So I don't think the basic tenet of finance has changed and will change. There will be risks which will come in, and those risks have to be factored in, but there's no fundamental change in investing paradigm. Risk and return, there's always a marriage, and that marriage will continue to happen. There's another question from Rajesh, which is, how did you grow despite competition from investment banks? Was it careful selection of niche segments like startup tech companies? So I think, Rajesh, the answer is yes. We started with what we call growing niche segments. We had certain hypotheses around tech, which turned out to be okay. But once you grow from a niche tech segment, we actually have grown very well in other segments. We also are the largest healthcare investment bank route right now in the country, one of the largest logistics. So our strategy was actually to go deep into certain areas and products and use that to essentially build credibility and excellence. And growing niche is one of the strategies which we use in every business. Fast expanding niche. Here's another question from Suryanaran Rajendra Babu. On the talent side, it's not always easy to acquire smarter people, especially whilst your venture is not able to afford them. How do we address that? It's not easy to acquire smarter people, but as discussed, it's the younger people sometimes don't fully understand their value. Some of the younger, smarter people, and there can be arbitrage in acquiring younger and smarter people who are mispriced in the market. There is, for example, one of the strategies which a lot of startups have adopted is actually acquire other startup founders who have failed startups. Since a lot of startups fail, there are a lot of startup founders floating around who have the aggression, the intelligence to actually build out businesses, and they can be fairly good hires as well for companies. Fortunately in India, I think there's a lot of talent pool, and continues to generate enormous amount of talent pool in the country, which makes India a very interesting country from a startup perspective, because it is tough to hire people, and you have to definitely do a great sales job in hiring some of the talent, and you have to show a 5 to 10 year vision. But once you do that, I think there's enough talent depth in the country to actually hire and acquire. Here's a question from Maniva Sagan Ramamurthy. Startups don't run out of business, but it's running out of cash. Can you talk about the key steps you might have to take as a startup to stay alive during those times? I think running out of cash is an absolute panic scenario, which happens to startups all the time. So one of the biggest things is to first plan for it, and typically be overcapitalized. Some of the mistakes which startups make is they get either bothered about their shareholding, the founders, or they get bothered about the valuations, and which means they don't sit on enough buffer capital. Assuming the world is going to be rosy, which typically good investors understand, having been in markets for very long, that volatility and black swan events happen all the time, which means you need to actually plan for a longer runway with capital. And the good startups, the real good founders are the ones who raise capital in time for a longer tenure. If you running out of cash and you are in a bad market, then it's a very tough survival scenario. And typically, you will come out of it if you are a extremely resilient entrepreneur. But it's very difficult to actually do that. There's another interesting question from Sumit. What businesses are getting traction in COVID crisis, like EdTech for fundraising? Definitely, there are businesses which are benefiting. EdTech definitely is benefiting. There is going to be a large movement towards digital overall, which is complete consumption of content-led digital, like EdTech or streaming movies, um, or virtual parties. There are a lot of interesting areas which will come up. The whole virtualization of world behavior change, which is happening one way, is going to help the companies and startups, a new generation of startups raise capital. And I know for sure there are companies in edtech which are pivoting themselves to take advantage, or companies in education which are becoming edtech companies to take advantage of this. So there is a fundamental shift which has happened in the whole ecosystem over last 2 months. The second piece, healthcare, there's going to be definitely new business models which will emerge, from telemedicine to medical devices, new generation of medical devices. There's a complete new generation of entrepreneurs and startups which are going to come up. It's going to be a very interesting world actually, because every disaster is also an opportunity, and this disaster will also come up with a new set of opportunities fairly quickly. There's a question from Keshav Bansal.
Uh,
How do we? Yeah, please.
Hi. So there was actually another question, a very interesting question from Venkat. So
Yeah.
how did you make sure you and the other co-founders remain in sync with each other? So there would have been strong and diverse views. How did you
Yes.
align?
Yeah. It's an extremely important question. So first is there's no ideal world. Any founders, the reason you have diverse personalities, you will always have differentiated views. You'll always have conflict. You'll always have situations where you are actually sometimes feel that why are you in a partnership? Why are you with another bunch of founders? And these are all fair things in any relationship. So every relationship, and especially as close a relationship as a intra-founder relationship, is always going to have high degree of conflict. The only way you kind of, and we have been in partnership together as three co-founders for 20 years, is essentially mutual respect and same goal, same vision for the company. Um, Mutual respect, I've seen most entrepreneurs actually, once they end up spending 5 to 7 years together, mutual respect is pretty much you can take for granted. Um, Goals change sometime. And I've seen people after 10 years, 15 years of being co-founders, they actually end up having very different goals. The early stages of the companies is the most difficult as far as continuing a partnership between founders is concerned, because in early stages you don't know each other that well. You don't know the working style. The worst in people comes out when they're tested very badly, and some of the people they collapse when they're tested to the level which is required. So the early stages of the company is very critical, and I think that chemistry between co-founders in early stages is something where they need to deliberately invest, uh, and they need to invest behind that relationship. And if there are difference of opinion in company's direction, they need to actually logically sort that out. So there has to be a relationship building which is very deliberate, which is informal. There has to be real logical sorting out of issues, especially to do with direction in the company. I think if you can do all that and you have mutual respect, typically, you guys, as a team, as a founding team, you can survive.
Hi. So sorry to interrupt. Will you be able to mute Professor Tilly? He's been trying to.
Yes, I'm trying to actually do that.
Okay.
Actually, I'm not able to unmute him for some reason.
So what message is popping up?
It's saying IIT MA is on mute.
So Professor Tilly, can you please raise another request again?
I don't think that's happening. So maybe
I
let's
think we
continue.
can continue with the questions.
Let's do that. Okay. Just going to the latest ones which are there.
Sure. There's a question from Kaushal. So he said,
Yeah.
how do we hire the good talent to make infrastructure in early stage startups if we can't afford them?
Yes, I think I kind of went through that question.
All right. Okay.
Yeah. I think there's another question from Ankit Jain. Economic slowdown, must an investment bank become more agnostic in their approach, or should they maintain their niche approach? Um, in fact, our observation is in a slowdown, the more deep you are, the more specialized you are, better your outcome is, because profit pools and revenue pools shrink in everything, in all aspects. And as your profit pools and revenue pools shrink, you need to actually figure out what you are best at and stick with that. And it is very, otherwise, the best of every segment will actually end up capturing that market. So one of the things you need to focus in is whatever you do, be excellent at that. And so niche approach might actually work. I would say more than niche, the excellence approach works. Another question from Nishant Kumar. In an early stage startup, what numbers would an investor look or convince them, as you've just started and our customer acquisition small with limited resources we have? So startups, investors are of all types. You have angels, you have VCs, and good thing in Indian ecosystem now is full ecosystem. You have full-fledged individual angels, you have angel networks, you have Series A investors, B investors, seed investors, D investors, and all of them have certain appetite. So depending upon who you are, and what you have built and how differentiated it is, and whether there's a product market fit that you have tested, um, and how good are you at selling your own concept, there are always investors available. In a normal market, of course, today's market is a bit special, but in a normal market, there are investors available, even if you don't have enough traction or enough revenue. But I think most investors will like some proof of concept, some early stage proof of concept, which doesn't need to be crazy numbers, but the fact that you have some happy customers with whatever product you have created. If you can demonstrate that, I think you will definitely find some interest. I think there's Sumit Agarwal. I've answered your question, Sumit, and uh, you know I'm sure happy to connect on any further thoughts that you have on your own startup. I think we are pretty much done with the questions. Shall we draw the session to a close?
Sure.
Okay, thank you, everyone.
So,
Thank you for hosting this, and thank you for to you guys and IT Madras for helping hosting this. Thank you.
so thank you so much for a very interesting session, and I really appreciated your approach.
Yeah.
Very interesting comic strips, and thank you all so much for joining us today. And we hope to see you in our upcoming webinars. If you have any questions that we have not that you've not already asked or that we've not answered yet, please feel free to reach out to me, and we will get back to you.
Thank you.
Thank you so much.